Hey guys, Rico here. Big news just dropped last week. The Fed officially cut rates for the first time since December 2024. That's right, almost 9 months without a cut. And now we've got one. Not only that, the Fed signaled 2 more cuts could be coming this year. So what does this mean for you, for me, and anyone living off high yield ETFs or dividend income? Today, I'll break down what this rate cut really means across the market, from tech, S&P 500, to REITs, energy, BDCs, even consumer staples. And by the end, you'll know the risks, the opportunities, and how you might diversify to protect yourself no matter what comes next. Make sure you stay till the end so you can see what I'm doing to make sure that I can benefit most from these cuts. If that's what you're looking for, you're in for it today. Let's go. Welcome back guys. Rico here. Quick disclaimer before we get into it. This is not financial advice. I am not a financial advisor, and for sure I'm not your advisor. This video is for educational and inspiration purposes only. Always do your own research and invest according to your own personal goals. Never just follow random people on YouTube. And now you know, and knowing is half the battle. So let's start with just the facts. So the Fed cut rates by 25 basis points, which for us normal people means 0.25%, bringing them down to the range of 4 to 4.25%. And some people wanted a bigger cut, more along the lines of 50 basis points. But I think that could have had a more negative impact than a positive one. Many industries would have to adjust much quicker versus just taking a more strategic and intentional adjustment to the 25 basis point cut. Keep in mind, this is the first rate cut since December 2024, which I talked about in the open. So it's been a long time coming. And the Fed signaled that there could be 2 more cuts that are likely before the end of the year. And Jerome Powell said this was about risk management. Inflation is still sticky, but the labor market is cooling off, so they're trying to stay ahead of a potential slowdown and a potential recession. And I'm not using the R word here. I'm just saying this is what they're doing, or this is what Jerome Powell said. So here's my question for you. Do you think the Fed is cutting because they can or because they have to? Drop your comments and thoughts down below. I'd love to hear how you're reading this one. Keep it kind as always. Now, let's talk about what this means for income investors like me, like you, and we'll talk about some real examples. And just for kicks, I'm including things that are in my own portfolio. So for those of you that like tech, much like me, we'll look at QQQ and QQQI and see what could happen. So QQQ tracks the NASDAQ 100. So lower rates typically boost growth stocks like this one because borrowing is cheaper and future earnings look more valuable. This means further investment, further growth, and perhaps a continued bull run. Usually cutting rates are good for these big tech businesses. In QQQY, this is the covered call version by Neos. This adds more steady income, but it can continue to cap the upside if tech really rips. So in this case, you might see increased distributions and slight increase in share price, but it'll feel capped because of the intentional covered call strategy. And we all know this. It's a blend of the two that give you growth plus yield. And that's what I do. QQQ in the retirement account, QQQI in the income account. Now let's talk about, for those who like broader exposure, which I'm a huge fan of too, we're going to look at the S&P 500 through the eyes of SPY and SPYI. So SPY gives you market-wide exposure. So rate cuts generally push the whole market up, and this is because the same exact reasons as tech companies in the NASDAQ. Cheaper loans typically means more investment, which leads to more hiring, more growth, more expansion. So for SPYI, this has very much the same potential as QQQI, but with broader exposure into more than just tech, right? Same pros, same cons though, solid income, capped price growth. Is what it is, but we all know that when we invest in covered call ETFs. Now, this is where it gets a little more interesting. Real estate, because real estate is dependent on interest rates, and REITs are highly rate sensitive. So lowering borrowing costs can make acquisitions and refinancing cheaper for businesses and for individuals. FYI, if you bought at the height of the rates, might be good to start looking at refinance rates in the next few weeks. So continuing with real estate, IYRI is an ETF I hold. It's a broad REIT ETF that could give you real estate exposure across the board, giving you solid income, but also participating in the growth of real estate as an industry. You could also look at traditional REITs like Realty Income and Agree Realty, and they also stand to benefit if this cut sparks real estate demand. But if cuts are recession driven, demand could stay soft. And that's the potential downside of these cuts. For my energy peeps, energy companies often borrow a ton to expand their infrastructure. So lower rates make that financing cheaper, which can lead to more expansion and growth. For Energy Transfer specifically, they do tons of acquisitions. So that could help them pick up more growth. And if growth picks up, demand for oil and gas rises, and then ET will continue to benefit. But if rates are a warning of weak demand, energy can feel the squeeze of cutbacks and a falling economy. So that's something we'll talk about in the next section. So stay tuned. Okay. Now I also want to talk about BDCs. BDCs are a big part of my portfolio, and it's another decent industry in my portfolio. BDCs are very sensitive to interest rates also. Most loans are floating or variable rate, so when rates drop, their income usually falls, and they then have to make revenue adjustments because of the lower income. It's just math. Lower interest rates means lower finance costs, lower income. So BDCs like Hercules Capital and Blackstone Secured Lending, they both thrived during the high rate times, but with cuts, their net investment income could shrink and the dividends may come under pressure. So I don't expect their dividends or their distributions to drop, but we need to keep an eye on them. On the plus side though, cheaper capital encourages deal flow. So strong BDCs with good credit quality, they can still thrive because they're still going to invest and still give out loans to startups and other small cap businesses, medium cap businesses, etc. Okay, finally, let's talk consumer staples. Staples are defensive. Whether the economy grows or slows, people will always need to buy food, toiletries, medicine. So stocks like Coca-Cola, Procter & Gamble, ETFs like XLP are steady dividend pairs and a great diversification play. They may not grow at the rate of NASDAQ companies, but they're also nowhere near as volatile. Talk about steady Eddie. You're not going to see super highs. You're not going to see super lows. You're just going to see straight up tortoise during the race. Okay. Now that you kind of know the different players in the game, let's talk about two different scenarios that these rate cuts can signal. So first, let's be optimistic and look at this as a good cut scenario. So what does this unlock? So it can unlock cheaper access to capital. So companies can expand faster, industrials, growth stocks, and even small caps can thrive with cheaper access to funds. Basically, you can go find a loan pretty easily. Real estate demand rises. Homeowners can refinance, buyers jump back into the market, and commercial properties become more profitable to finance with better and more solid cap rates. So you can buy more multifamilies or office buildings. They just become better and easier and make more sense to acquire. Energy companies like ET can expand their pipelines or drilling progress or anything like that more affordably because the loans to do these things are cheaper. And then BDCs can see more deal flow and more refinancing activity. And even with lower spreads, this increase in activity can provide more profits. And there are typically more startups and more opportunities to invest in during these times. In the good scenario, consumers gain confidence and inflation will start to cool, and this will start to boost discretionary spending and add to more growth sectors. So this is the optimistic view of things. I'd like to think that this is probably where we're going, but we have to talk about the other version. So what is it when it's a bad cut scenario? What does it signal about the economy? So the Fed might be cutting rates because the economy is already weakening, and Jerome Powell already hinted at this. Inflation is still not where it wants to be. It's sticky, job growth is slowing, and unemployment has ticked up to 4.3% in August. And all this according to the meeting they just had last week in Washington, D.C. And businesses are slowing down, and BDCs like HTGC and BXL earn less as their floating loan income declines. And if defaults rise, definitely the payouts will be at risk, which means their distributions could feel the pressure. Again, I'm hoping they don't cut their distributions, but we'll see, right? REITs could suffer also if commercial tenants pull back or home buyers can't qualify for loans because of job losses and just an overall weak economy. Energy struggles as demand falls during recessions for sure. And then growth stocks, they lose steam because investors will tend to retreat and move into more defensive plays like consumer staples and healthcare, while they leave their explosive growth of stocks like Nvidia or Robinhood. Now, not saying this is what will happen, but just saying some signs are pointing this way. So the key question is, which cut do you think this is? A healthy growth feeling cut or a warning sign of trouble? Comment down below. I'd love to know where you stand. And look, I don't want to be bearish. I'm not the bearer of bad news, but the sound bites from the Fed meeting point to this potentially being a bad rate cut. But the upside is the rate cut happens to stimulate the economy. So it's not a foregone conclusion that we're going to go into a recession or anything like that. Hopefully, by cutting the rates, we avoid a down economy like that. So no matter which way you're thinking about it, which way you're leaning, here's how you can position yourself, and more importantly, why these strategies that we're going to talk about next can help all of us. So first, you want to blend growth and income ETFs. So look at potentially pairing QQQ with QQQI or SPY with SPYI. And that way, if growth rallies, you capture the upside, but if growth stalls, you're still earning strong, consistent income. Think about adding REIT exposure, but do it with care. REITs benefit massively from lower rates, but stick to high quality names like Realty Income and Agree Realty that have strong tenants and balance sheets. They can weather tougher scenarios, and they've continued to increase distributions even through multiple downturns. So definitely look into those, not saying you add them. Next is like add or stick to consumer staples and dividend aristocrats. These survive any economy. Like people will still buy groceries, medicine, soap, pay for utilities. Stocks like Coke, Procter & Gamble, and ETFs like XLP provide reliable dividends no matter what the economy is doing. Next, tread lightly with your BDC allocation. So Hercules, Capital, and Blackstone are great examples. They thrived during high rates, but with cuts, their income could shrink. Keep them in the portfolio, but don't overload. Treat them as higher risk, higher yield income. That's what I'm doing. And then finally, always watch the data. Follow unemployment trends, inflation trends, consumer spending. If the economy holds strong, lean more into growth and REITs. If it weakens, tilt into more defensive with staples and perhaps some covered call ETFs. Things that can still provide you with strong, reliable income. That's what I'm doing. No matter what economy we're in, these are just kind of good principles to invest by. And always remember that diversification, that's your shock absorber. It smooths out returns and helps protect your capital no matter what the Fed is signaling, no matter what the economy is doing. So that's my breakdown on the Fed's latest rate cut and what it means for high yield ETFs and income investors. Remember, this is the first cut since December 2024, and with potentially 2 more this year, the story is only getting started and really only time will tell. Now, I want to hear from you. What do you think of all this? How are you preparing? Drop your thoughts in the comments down below. I'll hope to feature some of your answers in the next video. A lot of these videos that I produce and I make are based on comments I get from you, so please keep them coming. Thank you for watching. If you got value out of this, please give it a thumbs up and subscribe if you haven't already. I really appreciate you, and if it doesn't challenge you, it doesn't change you. Messy action is better than no action. Take care, and I'll see you next time. Boom.